Welcome back to the Uncovered Economy. Oil just shocked global markets with a breakout that most investors were not prepared for. This was not a small bounce. It was not routine volatility. It was a decisive push through resistance at the exact moment geopolitical tensions intensified. And when oil moves like this, it rarely stops at energy alone. It usually sends ripples across the entire financial system. If you care about protecting your purchasing power in the United States, this matters more than you think. Because oil is not just a commodity, it is the backbone of inflation. Before we go any further, if you want clear macro signals before they become headlines, hit subscribe right now. Timing in cycles like this can make all the difference. Most people react after confirmation. The smart money positions before it becomes obvious. Oil may have just fired the first warning shot. Markets do not wait for official declarations of conflict. They move on rising probability. When headlines begin shifting toward escalation risk, traders adjust exposure instantly. Energy markets move first because supply risk is immediate and measurable. Roughly 20% of global oil flows through regions sensitive to instability. Even the possibility of disruption is enough to push futures higher. Energy traders do not need certainty. They price risk as soon as it appears. That is exactly what we witnessed. Oil surged through levels that had capped it for weeks. Momentum followed quickly. Volume increased. And that combination signals conviction rather than randomness. When oil breaks resistance during rising geopolitical tension, history says, pay attention. Now think about what higher oil means inside the U.S. economy. It means higher gasoline prices for consumers. It means higher transportation costs for businesses. It means higher food and goods prices across supply chains. Energy touches nearly every part of daily economic life in America. When oil climbs sharply, inflation expectations rise. With it, inflation expectations influence interest rate forecasts. Interest rate forecasts influence bond markets. Bond markets influence real yields. And real yields heavily influence precious metals. That chain reaction is why oil's breakout is bigger than it looks. It is not just an energy story, it is a monetary story. And silver tends to respond when monetary tension builds. The first domino may have already fallen. Oil moving higher is not just a headline event, it is a shift in inflation psychology. When oil spikes, traders begin adjusting inflation expectations immediately. They do not wait for next month's CPI report to confirm the trend. They look at energy costs and project forward. Higher oil feeds directly into transportation and production expenses. Those expenses eventually show up in consumer prices. When inflation expectations rise faster than interest rates, real yields decline. Real yields are one of the strongest drivers of precious metals. When real yields fall, holding non-yielding assets becomes more attractive. That includes gold. But silver often moves more aggressively than gold once momentum builds. Silver's market is smaller. It requires less capital to create larger percentage moves. That volatility is what makes silver explosive during inflation cycles. Historically, oil spikes have preceded major silver rallies. In the 1970s, energy shocks fueled inflation and silver surged dramatically. In 2011, commodity strength and global instability pushed silver close to record highs. In 2020, volatility initially hit metals before a powerful rally followed. Each time, energy instability played a meaningful role. Oil sends the early signal. Inflation expectations follow. Real rates adjust. Silver accelerates. That pattern has repeated across decades. It is not coincidence. It is structure. Silver sits at the intersection of monetary hedge and industrial demand. It benefits from inflation fear. It also benefits from infrastructure and technology demand. Now, look at the current U.S. environment. Federal debt has surpassed $36 trillion. Interest payments are rising quickly. Consumers are already sensitive to elevated costs. Oil climbing into that environment increases pressure. If inflation reaccelerates, the Federal Reserve faces renewed difficulty. Raise rates and risk slowing growth further. Hold steady and risk inflation climbing again. Neither path is easy. Both paths increase uncertainty. Uncertainty drives defensive allocation. Defensive allocation often includes precious metals. Silver sitting beneath resistance levels becomes a magnet for momentum traders. If oil holds its breakout, pressure builds beneath silver. And when pressure builds long enough, release tends to be sharp. From here, markets face three realistic paths. The first path is de-escalation. Tensions cool and oil retraces part of its breakout. Inflation expectations stabilize instead of accelerating. Bond markets regain some calm. Volatility begins to decline. In this scenario, silver likely consolidates rather than explodes higher. The risk premium priced into oil fades gradually. Precious metals pause instead of accelerating. Markets shift attention back to domestic data. Investors focus on employment and GDP again. The Federal Reserve regains breathing room. Real yields stabilize. Silver trades sideways for a period. This would turn the breakout into a temporary shock. The second path is prolonged tension without direct escalation. Oil remains elevated for weeks or even months. Inflation expectations stay firm rather than falling back. Bond markets remain sensitive to energy prices. Investors slowly increase defensive positioning. Silver begins grinding higher instead of spiking in a single day. This type of environment often supports steady metal rallies. Inflation becomes a background narrative again. Policy uncertainty lingers instead of disappearing. The Federal Reserve faces ongoing pressure. Rate expectations become unstable. Real yields remain vulnerable to decline. Momentum builds quietly beneath resistance. Eventually, resistance gives way. Acceleration follows. The third path is rapid escalation and broader financial shock. In sudden shocks, liquidity becomes the priority. Investors may sell risk assets aggressively. Sometimes, even metals are sold briefly to raise cash. We saw this pattern in 2008. We saw it again in early 2020. Liquidity squeezes can distort short-term price action. However, once central banks respond, metals often rebound strongly. If policymakers inject liquidity, inflation risk increases further. Inflation risk supports hard assets. Silver can move violently during those transitions. Short-term volatility may be extreme. Long-term direction often favors tangible assets. Oil remaining elevated amplifies that probability. Duration remains the key variable. Now let's bring this back to you. This is not about panic. It is about preparation. Oil has already made its move. Silver is positioned just beneath resistance. Markets rarely give long warnings before momentum expands. Understanding the signal is more important than reacting emotionally. If oil sustains its breakout, inflation narratives return quickly. If inflation narratives return, policy pressure increases. Policy pressure creates uncertainty. Uncertainty fuels defensive allocation. Defensive allocation often includes precious metals. That chain reaction is logical rather than dramatic. It is grounded in structure, and structure is shifting. Silver remains volatile by nature. It does not move in straight lines. It surges, retraces, consolidates, and then often surges again. Strong trends usually begin quietly beneath resistance levels. Momentum builds before headlines change tone. Retail investors often enter after confirmation. Institutional capital tends to enter before confirmation. Oil's breakout may represent that early positioning phase. If oil holds its current levels, silver's breakout probability increases. If oil climbs further, the probability increases again. Markets reward anticipation more than reaction. Waiting for certainty often means entering late. This is why macro awareness matters. Oil just delivered a macro signal. Now I want to hear from you. Do you believe this oil breakout is temporary noise? Or do you think we are entering another inflation-driven cycle? Drop your thoughts in the comments below. I read every single one. Real discussion strengthens understanding. If this breakdown helped you connect the dots before mainstream headlines do, share this video with someone watching gold, silver, or energy markets. Most investors react after the move begins. Markets move before confirmation. Oil already moved. Silver could be next. This is the uncovered economy. We focus on signals before they become obvious narratives. Stay disciplined. Stay analytical. Stay ahead of the curve.